Hi guys, welcome back again. So I'm going to do the second example with you, which is the full goodwill method. We're going to assume the same data from the previous example with Corio and Yara, except that this time you're asked to use the fair value method. And if you're asked to use the fair value method, the fair value of the NCI will be given to you. Okay, which means you won't be asked to calculate the fair value of the NCI. So where does this 1.5 million comes from? In this example, it's simply given, but in practice, what would you do? So you go back to ASB 3 for guidance. This standard allows the acquirer to measure a non-controlling interest in the acquiree at its fair value at the acquisition date. Sometimes the acquirer will be able to measure the fair value of the non-controlling interest, and that's if an active market is available for the equity of the subsidiary. Okay, for example, if the subsidiary is listed on the Australian Stock Exchange, then all you do is get the share price multiplied by the number of shares owned by the non-controlling interest. The accounting standard says that if there's no active market, that you should still calculate it and find other valuation techniques to do so. So this is how the consolidation journal entries are going to be different if we're using the fair value method. Note that your consolidation entry to revalue the land is still the same, but your elimination entry is going to be different. Okay? Why? Well, your elimination entry will be different because now you'll have to calculate the goodwill for the NCI. Okay, so how do you calculate it? Well, it's given to you already that the fair value of the NCI is 1.5 million. If you go back on slide 16, you'll find that the fair value of identifiable net assets attributable to the NCI is $1,450,000. Okay, so go back to slide 15 to see this. So the difference here gives you a positive figure, which is $50,000, and this $50,000 is the goodwill attributable to the non-controlling interest. Okay, so when you have a look at the goodwill here, the amount is different to our first example. In our first example, the goodwill that we calculated for the parent was $650,000. We calculated goodwill here for the NCI, it's $50,000. Okay, so this is goodwill for the NCI from the group's perspective. This is goodwill for the parent from the group's perspective. Okay, so that gives you a total goodwill of $700,000. The NCI equity is also going to increase, okay, because what we're doing here is we're increasing an asset, being the goodwill, and when we do the accounting for NCI, we only have this account called NCI, which is an equity account. So if you're increasing an asset, and you think about your balance sheet equation, if you increase an asset, the equity has to increase as well, because assets minus liabilities is equal to owner's equity. Okay, so we credit NCI equity. In other words, we're increasing this account if we have to calculate goodwill for the NCI. Our adjustment for the dividend stays the same, so I won't go through the calculation again. The adjustment for the lease and other expenses stay the same, so I won't go through the adjustments again. Revenues, payable, they all stay the same. Okay, and I've already gone through this with you. The calculation of the NCI's other share of other equity stays exactly the same. Okay, so once again, I won't go through this with you because they have not changed. So only one thing has changed in your, and that's your elimination entry, where we increase goodwill and we increase the NCI equity. This is how your memorandum is going to look like now. So it's very similar to the first memorandum in the first example, where we get the NCI share of retained earnings, the NCI share of profit, the figures are the same, the NCI share of dividend, the NCI share of issued capital, and the NCI share of fair value adjustment. So for now, everything is the same. And what I'm wondering in this slide is whether something is missing. Maybe there was something at the bottom but did not get captured in the PDF version of this file. But there's something missing here, and that's you have to add to this list goodwill. So you would add a goodwill of $50,000 to this list. Okay, so when you get to the total, don't forget to add this $50,000. So you add 530,000 plus 217,500 minus 115,000 plus 875,000 plus 175,000 plus $50,000. Okay, that will give you the amount of the NCI. So how does the presence of NCI impact on goodwill impairment? Okay, note we've have a look at goodwill impairment before, and I hope that you've already tagged your accounting handbook for where we did impairment of goodwill. Okay, so continuing on that, if you're using the proportionate method, the carrying amount of the goodwill is to be grossed up so that the NCI in goodwill is included within the parent's interest in goodwill, and then 100% of the recoverable amount of the subsidiary can be used in calculating in performing this impairment test. Okay, in other words, what you're doing is bring the goodwill of the parent to 100%. So in the last example was 75%. Bring it to 100%. Compare it with 100% of the recoverable amount, and then you perform the impairment. So once you've decided that there is an impairment loss, then you're going to apportion the impairment so that only the parent records the impairment loss. The non-controlling interest cannot record the impairment loss under the proportionate method, because under the proportionate method, the NCI does not have goodwill and therefore cannot impair the goodwill. So there's a good example you can follow in the accounting standard ASB 136, example 7A. Alternatively, if we're using the 100% goodwill method, then any impairment loss will be split between the parent and the NCI on the same proportionate basis as the profit, as how the profit is being split. So if we look back at our previous example, then you will do an impairment. The parent will get 75% of the impairment, and the NCI would get the remaining 25% of the impairment. Okay? So example provided in the accounting standard, example 7B. So we've had a look at a very simple example. It is very likely that there will be other types of intra-group transactions, especially the ones we've looked at last week, that were actually harder to record. So the requirement of ASB 127 is to eliminate all intra-group transaction in full. Okay, and this stays even if there is non-controlling interest. We will still be eliminating all intra-group transaction in full. That is, we will be eliminating 100%, because from the group's perspective, the parent controls the subsidiary, and therefore it controls 100% of the assets and liabilities in the subsidiary. With our elimination entry, everything stays the same for intra-group transactions except for dividends, and we've already looked at an example with dividends where you only eliminate the parent's proportionate share in the dividend. But with all the other consolidation entries, you will be eliminating 100% of the intra-group transaction, just as you saw with the lease on the asset, on the lease and the accounts payable and accounts receivable on the borrowings. So how does intra-group transaction impact on the calculation of the non-controlling interest? When you calculate the non-controlling interest share of profit, you need to calculate the subsidiary's profit after eliminating income and expenses of the subsidiaries, sorry, that are unrealized from the economic entity's perspective. So in the example of Corio and Yara, we simply took the amount of the profit and then distributed that to the NCI. But in other circumstances, you might have to fix the profit of the subsidiaries first. By fixing, I mean remove the amount of unrealized profit first and then allocate to the non-controlling interests. So whenever we have unrealized profit, we're going to deduct that amount from the subsidiaries' profit. Adjustment to the calculation of the NCI's share of subsidiaries' profit will be needed where some or all of the inventory sold by the subsidiary is still on hand with the parent entity at reporting date. This is called an upstream transaction. Okay, so when we're doing intra-group transactions, differentiating between upstream and downstream transaction is very important. So what's upstream, what's downstream? The parent is always in the highest position, and then we have the subsidiary. When the subsidiary sells to the parent, this is what we refer to as upstream. When the parent sells to the subsidiary, we call it downstream. When we're trying to fix the subsidiary's profit, we only care about upstream transaction. Why? Because we only care if the subsidiary's profit includes unrealized profit, because what we're calculating here is equity that goes to the NCI, and only the subsidiary's equity or profit goes to the NCI. We don't have to fix the parent's profit for the purpose of calculating the NCI. Okay, so inventory sold by the subsidiary is still on hand. If you recall from last week, when you have an intra-group transaction that includes inventory, only unrealized profit in the remaining inventory is relevant when calculating unrealized profit. So if you remember, I can write it for you here. To calculate unrealized profit last week, we took selling price minus cost of goods sold, and then we did multiply by the percentage that remains, that is the percentage unsold. That's what gives us unrealized profit. Okay? So what happens, what this slide tells you here is that unsold inventory will decrease your NCI because that's unrealized profit. Okay? So if you have remaining inventory in closing inventory, you will have to decrease the NCI. So any unrealized profit always has the same effect on the NCI decrease. But if you remember with inventory, it's always sold in the next financial year, which means closing inventory last year becomes opening inventory in the next financial year. So if this is the line that shows you the beginning and the ending of the financial year, closing inventory becomes opening inventory. That is, whatever you have that's unrealized last year will become realized in your current year. Okay? Why is it realized? Well, if this is your inventory, somewhere in your current year, this inventory will be sold. And as soon as your inventory is sold, it becomes realized. Okay? So how does that impact on your NCI share of profit? Well, when you have realized profit, you have an increase in your NCI. Okay? So unrealized profit in closing inventory would decrease NCI. But when you're told that there's unrealized profit in opening inventory, this means it will be realized in your current year. Okay? Can we assume that the inventory is sold in your current year? Yes, you can assume so, because inventory are usually sold within 1 year because they are current assets and therefore are converted into cash within 1 year. If the subsidiary sells a non-current asset, like any sort of property, plant and equipment, land, equipment, machinery, etc., then the gain or loss on sale is not recognized from the group's perspective. And if that's the case, we can't recognize this unrealized profit for the calculation of the NCI share of profit. So what will happen here is you will have to calculate the amount of unrealized profit and then use that to decrease the NCI. Okay, why? Because here you'll have an unrealized profit. And if you recall from last week, unrealized profit on a depreciable item becomes realized through depreciation. So as the item depreciates, you're going to realize the value, or you're going to realize the gain on sale. Okay, and if you have realized profit, you're going to end up increasing the NCI. And you've already learned how to calculate all of these numbers last week. If we're dealing with intra-group services and interest payment, and this is what we saw in the example of Corio and Yara, then no adjustments will be necessary when calculating the NCI share of profit and the NCI share of equity. Page 314 from your textbook states the following. If consolidation adjusting entries only affect specific accounts in the consolidated statement of comprehensive income and have no effect on consolidated net assets, they should be ignored in the NCI allocation. So if you have a look at the entry we did for interest revenue, we did debit interest revenue, credit interest expense. That's in the Corio and Yara example. These two entries will have no effect on profit. Therefore, we don't have to make an NCI adjustment. If you look at the one that we did for intragroup borrowings, there was a debit to the borrowing payable and a credit to the borrowing receivable. Net impact on profit was 0. Okay? So no NCI adjustment. How about intragroup transactions that creates unrealized gains or losses for the parent entity? If that's the case, you need to ignore these types of transactions, okay? Because this will be recorded in the profit of the parent, and the NCI does not get a share of the parent's profit. Therefore, these types of transactions will not impact on NCI calculations. So this is it for the lecture on consolidation accounting with NCI. So we're going to do more of these calculations and entries for next week. And I think your homework questions for next week are pretty easy. But when it gets to exam questions, they will be harder. And don't worry, we will be practicing big questions. Well, Helen will provide practice questions on consolidation with NCI that we will do together in class. Okay? So thank you for listening and have a good night.